Momentum. That is the term used to describe the natural flow of orders that affect the price action of a stock. Understanding and anticipating this natural flow gives a trader a significant advantage when trading, especially intraday, as split-second decisions sometimes must be made. A trader truly in tune with the momentum of a stock can almost predict to the cent what will occur next. Therefore, it is important to learn how to accurately read the momentum, as this will provide vital information on how far a stock can continue to move in a particular direction before reversing. And let's face it, that kind of insight can help you figure out when it's an opportune time to enter or exit. In this video lesson, we will explain each step in the momentum cycle and how to effectively use it when trading. Okay, in front of you is a diagram illustrating the natural flow of orders during an aggressive sell-off. From this illustration, you can see that we have marked off 8 different sections along the move. Assume that a significant level of support was broken through prior to the down move we see here, started by section 1. We will evaluate how bids and offers react during each of these sections. Being able to comfortably identify the different phases of momentum is essential, as this will help you make educated forecasts when deciphering the price action of a stock. The order flow during each phase of a stock's movement when a sudden drop in price occurs is as follows. In phase 1, after a breakdown through the support level, large offers come in and begin stepping down in price, with the majority of the transactions, also known as prints, occurring on the bid. In phase 2, the spread widens as a continuous stream of prints on the bid occurs as share size dissipates, basically meaning that liquidity dries up as bids back away from the line of fire, forcing sellers and shorts to think twice before taking out more bids due to the wide spread. In phase 3, the spread tightens with prints dramatically slowing down as bids hold, creating temporary support. In phase 4, quick prints on the tape, often large, significantly take out offers as many shorts cover their positions. In phase 5, large bids come in and begin stepping up in price, with the majority of the prints occurring on the offer. In phase 6, the spread again widens as this time a continuous stream of prints occur on the offer as share size dissipates, basically meaning that the liquidity dries up as offers back away from the line of fire, forcing buyers to think twice before taking out offers due to the wide spread. In phase 7, the spread again tightens with prints dramatically slowing down as now offers hold, creating a temporary resistance. And in phase 8, quick prints on the tape, often large, significantly take out bids as longs exit their positions, thus resuming the downward move. Okay, so assuming you had entered short at the breakdown through support prior to phase 1, where would you possibly exit some, if not all, of your position? Here, take another look at the illustration of the 8 different phases before you make your decision. While most people answer phase 3, the correct answer is actually phase 4. The reason is, during phase 3, all you know is that a temporary level of consolidation has formed after a significant down move. You do not have any reason to believe that the temporary level of support will not be broken, thus producing you with more gains. Therefore, you should stay in the position until phase 4, once the mini consolidation is broken, thus confirming the move for at least the moment is over. Exiting in phase 4 instead of phase 3 will maximize your potential for gains, as you will not take out of trades prematurely. In a follow-up question, where would you look to re-enter or add more to the position? Use this illustration again to make a decision. Both phase 7 and phase 8 are safe choices. However, the problem with entering in phase 7 is that you may have to wait a long time before you find out whether the decision is a correct one. While this roller coaster of price action may seem unusual, it is actually very common, especially when the market volatility is high. This type of momentum can be found when scalping, intraday trading, swing trading, or even position trading. This natural pattern of momentum remains the same when using each of these trading styles. Just the speed, time frame, and distance change. Okay, now let's take a look at the diagram illustrating the natural flow of orders during a significant surge up in price. As you can see, this pattern is identical to that of the previous illustration, just flipped from down to up. The 8 sections along the move represent the exact same process as before, simply inverted. Therefore, to avoid being redundant, here's an alternative way to describe the order flow caused by momentum. When a significant resistance level is broken through, buyers aggressively take out offers. Offers then back away. This causes bids to slowly creep up. As a result, temporary consolidation occurs as a mini resistance level forms. Eventually, a breakback down occurs when bids are aggressively taken out by some buyers taking profits, as well as some shorts looking for quick gains. Then the stock consolidates once again at the previous level of resistance, which is now support. This consequently sends the stock back up again as new buyers identify the technical level, forcing shorts to cover. Okay, let's take a look at the following snapshots of Blackstone Group, ticker symbol BX, to help get a better understanding of momentum and how to use it to your advantage when trading. From the chart of this first slide, we see Blackstone consolidating near yesterday's closing price after a substantial up and down move early in the trading day. By taking a look at the ECNs, we see that a crowd seller on ARCA is creating resistance, while the moving average is creating support. In this second slide, we see the resistance level is broken through, as crowd at $10.20 is eliminated, which instantly spikes the stock, as this sign of strength entices new buyers to enter and at the same time forces shorts to exit. Now in this next slide, we see the stock make a sudden and sharp move back down to its previous consolidation, as some of those who had bought the breakout exit, taking quick profits. Remember, this is common as the previous resistance level, which is now support, is being tested. In this next slide, we see the stock successfully hold its support level, thus confirming strength. Because of this, shorts lock in quick profits and new buyers enter, thus creating a dramatic move back up. And from this last slide, we see a zoomed in chart of the price action that occurred in Blackstone. Notice how this pattern closely resembles that of the illustration previously shown. Once the stock broke through resistance, aggressive buying pressure came in during phase 1 and 2. During phase 3, mini consolidation formed. In phase 4, some buyers locked in profits while some shorts chose to enter. In phase 5 and 6, aggressive selling moved the price back down to where it originally came from. In phase 7, a level of support came in to hold the stock up, as technically it made sense. And in phase 8, the stock made a sharp move back up as new buying pressure came in. This is the flow of momentum. Now we purposely used a fairly small momentum swing because if you can learn how to comfortably identify smaller, quicker patterns of momentum, then you'll be able to master momentum of all distances and time frames. Having an understanding of each of the phases of momentum will raise your level of awareness as a trader and improve your tape reading skills, as well as help you identify high probability setups based on good reward to risk ratios. It will help you comprehend price action and make sense of chart patterns. Therefore, take time to learn what occurs during each phase of momentum so that you can anticipate and take advantage of typical price action in the markets.